you've done it. You've got your down payment sorted out for your first investment property, and you found a great property to invest in, and you're ready to become a real estate investor. It is an exciting moment, but now comes the step where most first-time investors make a big mistake, and that's about getting the financing. Here's the truth: getting a mortgage for an investment property is completely different than getting a mortgage for your primary residence. The rules are different, the lenders look at you differently, and the strategy is different. Walking into your personal bank and just asking them for their best rate on your investment property is not a strategy. It is what I call a hope strategy. My name is Dalia Barsoum. I'm the founder of Streetwise Mortgages, and welcome back to the Streetwise 10. Today we're tackling question number 3, which is how do you strategically finance your first investment property? I'm going to show you the strategic framework for getting your first yes from the lender, and why the mortgage you're getting for property number 1 can determine whether or not you will ever get to property number 5 and whether or not you're going to be able to scale up your portfolio. Before any lender even looks at your deal, they will evaluate your personal finances, and therefore ensuring that your personal financial house is presented in the best way possible is a critical first step. So let's take a look at the key elements that the lenders will look at. The first one is your credit score. For the best rates from the banks and what we call the A lenders, a credit score at 680 or above is the gold standard. But if your score isn't there right now, I don't want you to get discouraged, because there are options for you out there through the alternative lenders. They do offer programs for lower credit scores. An income property mortgage broker can guide you towards these options and can coach you on how you can improve your credit score for better terms down the road. Next is your personal income. If you are a salaried employee or a T4 employee, providing a proof is usually straightforward. But if you are a self-employed client or a business owner, the approach requires more strategic planning. If your personal tax returns show enough income to qualify with the banks, then you can definitely get excellent rates. But for many entrepreneurs, strategically minimizing your declared personal income is the norm. And in these situations, alternative lenders can offer you programs that are designed specifically for you as a business owner. They will look at your bank statements to confirm your income, and they don't care about how much you've reported on your personal tax return. And some of them actually don't look for the personal tax returns to start. And this is again where an income property mortgage broker can collaborate with your accountant to help you plan your income so that you can achieve your short and long-term financing goals. Now, the third one is down payment. For a deep dive into the down payment topic, watch my video on this channel titled How Much Down Payment is Really Required for a Rental Property in Canada. The amount depends on your strategy. The typical is 20% down. That's the standard on a rental property. But you can get into a rental with a 5 to 10% down if you're going to live in one of the units. And here is something that some investors may not be aware of when it comes to down payment. The down payment doesn't necessarily have to be all coming from your savings. Some lenders allow you to use a gifted down payment in addition to your savings, and some lenders allow you to use a portion from, let's say, an unsecured line of credit. The key is to plan your down payment in advance with an income property mortgage broker so that there are no surprises in the midst of the deal. Once the lender is confident in your personal finances, their focus shifts to analyzing the property itself. And this is what Pillar 2 is about. It's about the property's viability. And the goal here is to prove to the lender that your investment property is a sound investment. And that often requires specialist guidance. So let's take a look at the two things that the lenders will look at under this pillar. The first one is the rental income. Here is an insider secret for you. Every lender treats rental income differently. You may be renting your rental property for $2,500 a month, but some lenders may take only 50% of that rent for your mortgage application. Some of them may take a higher amount, like 80%, and some of them may take all of it. And you may think that working with a lender that will use all of the rental income is the way to go, but that's not necessarily the case. And here is why. It's because some of the lenders who are more aggressive sometimes on using all of the rents will be stricter on other fronts, requiring, for example, extensive paperwork or charging you a higher interest rate. So this is where the fine print really matters. And this is why understanding these lender nuances is crucial. The goal isn't to really maximize on the rents that the lender is going to use, but to place your application with the right lender so that you get the best financing today for the rental property you're buying, but to also keep the doors open for you to continue to grow down the road. The next thing that the lenders would look at under the property's viability is the appraisal. They want to confirm the value and the condition of the property. But here's the thing, appraisal is an art rather than a science. And when you go directly to the bank, whomever is available to take on the appraisal order will come and visit your property. But when you work with an income property mortgage broker, they can ensure that an experienced appraiser who understands the market, understands the rental property's game, comes and appraises your asset. Having the right expert's eye is what's going to make the difference between the value being supported and the value coming short. And when the value comes short, guess what happens? You'll have to inject more money into the deal. The appraisal also plays a big role into determining whether your deal will get approved or declined. Therefore, making sure that the right appraiser comes and visits and that they know the market and they know the type of investment property you're buying is super, super important. And finally, pillar 3, the deal structure. This is arguably the most strategic piece, and getting it right from the get-go before you firm up your offer is non-negotiable for setting yourself up for success in the long run. This involves asking a key question like, will you hold this property in your personal name or will you hold it in a corporation? Check out my video on this channel for a deeper dive into this topic. But your answer to this question is going to impact the type of financing you're going to get. It's going to impact your rate, it's going to impact which lender we're going to end up working with, and so on. So it is important to iron that out up front. You also want to think about how many people are involved in the deal. Is it you only that will hold title, or are you involving other partners in your deal? Because that will also impact financing. So getting the deal structure right from the get-go is crucial. It ensures that your financing goes smooth. It also sets the path for your future growth. If you get it wrong, that will impact your current deal, but will also create roadblocks down the road that will hinder your growth. So I invite you to have your accountant speak with your income property mortgage broker, and together they can discuss the implications of putting your rental in a holding company. Together they have to look at the pros and cons. Is it going to help you better from a tax standpoint? And how does it impact your financing? And if you end up putting it in your personal name, what does that do to taxes and what does that do to financing? Have them both talk to each other and help you plan better. Don't make this decision on your own, and do not make it in silo either, talking to them independently. So deal structure, absolutely crucial to address as early as possible and to set yourself up for success from the get-go. I'd like to share with you a big temptation that I've observed with first-time investor, which is chasing that shiny low interest rate. If you own a primary residence, having the lowest interest rate was probably one of the most important criteria for deciding on your home mortgage. But when buying a rental property, focusing on the lowest rate can be the most expensive mistake you can make. And here is why. First, you have to think long-term, like playing chess versus playing checkers. Every lender has a limit on the number of rental properties they will finance for you. At some point, they're gonna say, no, you're not approved. The bank, for example, offering the lowest interest rate on property number 1 might only allow you to finance 2 or 3 more with them, essentially cutting you off when you're gaining momentum. So here is the critical point. Where you place your mortgage today on your first investment property will impact directly your ability to finance your future deals. If you use up your borrowing capacity with certain lenders, for example, early on, you can unintentionally lock yourself out of better financing with other lenders down the road as you buy more rental properties. It is a complex numbers game, and considering your entire financing roadmap is crucial. This is where a qualified income property financing advisor can help you. They understand how lenders think. They can help you navigate this game strategically and make the best out of it. They, for example, might place your first mortgage with a lender that is offering a slightly higher interest rate, but who proves to be a good lender for you because they can allow you to scale up to your 5th or up to your 10th property. A good income property financing advisor will know how to manage your borrowing power. Second, that lowest interest rate is often bait attached to a restrictive product that will block your strategy or potentially block your growth down the road. So let me give you a specific real life example. Let's say you bought a pre-construction property a couple of years ago, and by the time you're closing, that property is worth more. Obviously, there is no guarantee, but let's say it's worth more. Naturally, as a real estate investor, you would want to tap into that built-in equity to fund your next deal or to get some cash back on closing. But if you just took the absolute lowest rate with a traditional lender on closing, you may get stuck. They will almost always lend on the lower of what you purchased the property for and what it's appraising for. So you get the financing on the lower amount, which is the purchase price, and your equity will get trapped. The Streetwise approach is for us to take your deal to the very few lenders on the street that will consider the higher value on closing. So they will lend on the appraised value, and that will give you a cash back on closing to cover your closing costs, for example. Another option would be to take your deal to a lender that allows you to set up a secured line of credit on the property after closing in 3 to 6 months to access that equity. Do you see the difference? Financing should enable the execution of your investment strategy, not hold you back. Saving a fraction on an interest rate meant nothing if, you were not able to access that $100,000 of equity. And that is what I call the rate trap. So do not fall for the rate trap when you are looking for a mortgage on your investment property. So as you can see, financing your first rental property isn't just a transaction. It is actually foundational to building your real estate portfolio down the road. It's about getting the 3 pillars aligned: your finances, the property finances, and the deal structure. But how do you make sure that all of these pieces work together in a harmonious way? This is where myself and my team come in. We've actually developed a service for starter investors and sophisticated investors called the Streetwise Financing Roadmap. And the best part is that this service is complimentary. It is a tool to help you set up financing in a strategic way to preserve your future borrowing power, to get the best financing terms for your current deal, and to avoid the costly mistakes that you may not be even aware of that can block your ability to grow down the road or hinder the effectiveness of your strategy. If you're getting ready to make your first move and you want to truly build a strategic financing plan, I invite you to connect with one of our Streetwise income property mortgage advisors and book a complimentary confidential planning session by clicking on the link in the description of this video. This was the answer to question number 3, folks, in the Streetwise 10 series. Make sure you subscribe to the channel and like this video if you found value in it, and watch for my next video answering question number 4, which is how do you grow your rental property portfolio in Canada and continue to finance it without hitting the financing wall. I would love to hear from you. I'd love to hear about your thoughts and surprises and lessons from financing your first investment property. I am going to read the comments. I read every comment and I will respond if you have questions as well. And for now, stay streetwise.